This video reviews a measurement of idiosyncratic risk. First, it illustrates the concept of the certainty equivalent using an example of donuts. This concept is then applied to a portfolio of securities. Finally, a series of hedge portfolios are created to show a risk function that mirrors the risk-free yield curve. So, let's begin. A person has $1 and the option of selecting between two donuts. One has blue sprinkles, the other red. Each donut costs $1, and each donut contains 50 grams of fat. As such, each donut costs 2 cents per gram of fat. Also, assume the following. People value fat because they are hungry, but they don't like fat because they are healthy. They have taste preferences in that some donuts are preferred to others, but they don't know which donuts are preferred ahead of buying them. Which donut will they choose? Before we answer this question, let's consider an alternative. Rather than buy one full donut, the person could buy 2 half donuts. Each half contains 25 grams of fat, for a total of 50 grams. How much would the person be willing to pay for this option? Let's call it a variety pack. Assume they would pay more, $1.50. Why? Because the risk of selecting a bad-tasting donut is reduced. Customers would also pay more per gram of fat in the variety pack, at 3 cents per gram, versus only 2 cents for the full-sized option. The extra cent is because they are paying to reduce the risk of selecting a bad-tasting donut. This is also known as the certainty equivalent. It states that when people are faced with risky outcomes, they would rather pay to have a certain outcome. Let's consider another alternative. Assume the price of the variety pack is $1, even though customers are willing to pay $1.50, so it seems like a bargain. This is also true on a price per unit of fat basis, at 2 cents per gram versus willing to pay 3 cents. This creates an opportunity for the baker to reduce fat contents, especially because customers are healthy. For example, they can remove 5 grams of fat from the blue donut and 10 grams from the red donut. Now, the total fat in the variety pack is 35 grams. And because it only costs $1, it costs about 3 cents per gram, equal to what the customer is willing to pay. So, to recap, let's use another example. Assume a box of 12 donuts costs $1 and contains 100 grams of fat. So, it costs 1 cent per gram of fat. However, the customer is willing to pay $2 for this, or 2 cents per gram. Assuming constant prices at $1, this allows the baker to remove some fat. In this example, 50 grams of fat are removed, and 50 grams remain in the box of 12 donuts. Now, the box costs 2 cents per gram, equal to what the customer is willing to pay. However, what if over time, the customer's taste preference become known or fade away, or all donuts begin to taste the same? Then, the risk of selecting a bad-tasting donut is reduced. The customer will value fat content alone, and the willingness to pay may decline, say to $1, or 1 cent per gram. Again, assuming constant prices at $1, and the same amount of fat at 50 grams, the baker must return the 50 grams of fat to the customer. Let's assume the baker provides a free donut to the customer, the 13th, which contains 50 grams of fat. Now, the price per unit of fat at 1 cent is consistent with the customer's willingness to pay. The baker's dozen is when the free donut is provided. The banker's dozen measures a preference for this free donut, but using a portfolio of stocks. For example, let's assume a person has $1 to invest and must choose between two stocks, A and B. Each stock costs $1, and each stock contains $50 worth of volatility. As such, both stocks cost 1 cent per unit of volatility. The price of each stock is measured as its historical return. Let's make some more assumptions. Investors value volatility because it drives returns, but they don't like volatility because it creates risk. In other words, assume that investors are risk-averse on average. Further, assume that investors have taste preferences but don't know which stocks they will prefer ahead of buying them. Now, let's consider the variety pack alternative, or portfolio concept. However, before we do, let's make a small adjustment to the base case scenario. Assume that stocks A and B have different volatilities. At 100 for stock A and 50 for stock B, each stock still costs $1, so the cost per unit of volatility is now 1 cent for stock A and 2 cents for stock B. Now, for the variety pack, assume that the investor puts half of their money in stock A and half of their money in stock B. They would own $50 worth of volatility in A and $25 worth of volatility in B for a total of $75. Assume that the cost of this portfolio is still $1. However, we know that investors are risk averse, so they would be willing to pay more than $1 for this portfolio. How much more would they be willing to pay? Alternatively, because prices are fixed, this creates an opportunity for volatility to be removed. But how much? Correlation does its job already. It measures how much stock prices move together. For example, lower correlation means that some stocks go up and others go down. This is what drives the benefits of portfolio diversification. Let's assume that stocks A and B are 20% correlated. This translates into $15 worth of volatility being removed from the portfolio. So, $60 remains. Further, it implies that the investor was willing to pay 1 2/3 cents per unit of volatility to own the portfolio. Now, how do we measure the certainty equivalent in this case? Let's do a quick review. The portfolio option costs $1 and contains $60 worth of volatility, which implies a cost of 1 2/3 cents per unit of volatility. Each individual stock costs $1, but stock A contains $100 worth of volatility and stock B contains $50. As such, stock A costs 1 cent per unit of volatility and stock B costs 2 cents. Now, in terms of measuring the certainty equivalent of the portfolio, which stock do we compare to? Because we own portions of each, but they have different per unit values. To overcome this challenge, we take a weighted average of the individual stocks. For example, we take 50% of the unit value of stock A and 50% of B. This is because we own 50% of each in the portfolio option. "50% of stock A equals half a cent per unit of volatility, and 50% of stock B equals 1 cent. Adding them together, we get 1.5 cents per unit of volatility. Comparing the options, investors were willing to pay 1/6 of a penny more on a per unit of volatility basis for the portfolio. This difference is equal to the certainty equivalent. Let's review this concept with an illustration. As more securities are added to a portfolio, the total risk in that portfolio declines. This is because of the benefits of correlation, as mentioned earlier. There are no benefits to owning one stock, but eventually, as all of the stocks in the market are included, there will be a certain amount of risk that can't be eliminated from correlation. This is known as systematic risk. The amount of risk that gets eliminated is known as idiosyncratic risk. So, let's continue with the two-stock example and say it corresponds to this point in the risk curve. We have eliminated this much idiosyncratic risk in the portfolio. However, we still own this amount of idiosyncratic risk. And this amount of systematic risk. Let's mark the two-stock portfolio as point X on the risk curve. We calculated earlier that investors were willing to pay 1 2/3 cents per unit of risk to own this portfolio. Let's mark the weighted average portfolio as Y above the risk curve. It's marked above the curve because we assume that the benefits of correlation do not exist. We calculated earlier that investors were willing to pay 1.5 cents per unit of volatility to own this portfolio. The difference of 1/6 of a penny is the certainty equivalent. In other words, it is how much investors were willing to pay to part with idiosyncratic risk. Now, what if we wanted to own portfolio Y? Because right now, practically, portfolio X and Y are the same, and that they both contain 50% of stock A and 50% of stock B. the banker's dozen adjusts the security weights to own portfolio Y. Specifically, we adjust the weights of stock A and B in portfolio Y so that the certainty equivalent versus portfolio X is 0. For example, we have the two stocks, A and B, each costing $1, with volatility of 100 in stock A and 50 in stock B, so that stock A costs 1 cent per unit of volatility and stock B costs 2 cents per unit of volatility. What portion of the investor's dollar should be put into stock A and what portion should be put into stock B so that the price per unit of volatility is equal to 1 2/3 cents, i.e. equal to the willingness to pay per unit of volatility in the traditional portfolio X. This is calculated to be 83% into stock A and 17% into stock B. To recap, we have assumed that the benefits of diversification do not exist structurally, so idiosyncratic risk is present. However, we assumed that the investor is not willing to pay to part with this idiosyncratic risk versus the traditional portfolio with diversification benefits. As such, we assume the investor effectively and practically owns the idiosyncratic risk. Let's review this concept across different portfolio sizes, where we have portfolio size, or number of stocks, on the x-axis, and risk, or volatility, on the y-axis. In the example of two stocks, at this point in the risk curve, we mark the traditional portfolio on the curve as X, and the banker's dozen portfolio on the top is Y. The difference in terms of risk ownership between the two portfolios is marked here. As more stocks are included, more idiosyncratic risk has been eliminated in the traditional portfolio. Think of this as a hurdle rate for relative performance of the banker's dozen versus the traditional portfolio. Larger portfolio sizes indicate greater differences and higher hurdle rates. Because investors are risk averse on average and prefer to part with idiosyncratic risk, this should imply that the banker's dozen will perform relatively worse than the traditional portfolio for larger sizes. This is indeed the case. Lastly, it should be noted that correlation has an impact on the relative performance hurdle rate. For example, with higher correlations, the benefits of diversification become muted, so the curve flattens, and the hurdle rate shrinks. Let's extend this portfolio size concept and compare it to the risk-free yield curve. If investors prefer certainty, they will purchase government bonds, lowering their yields and the risk-free rate. Further, if investors prefer certainty, they will pay more to part with idiosyncratic risk, and the banker's dozen will underperform. As such, rising risk-free yields should correlate with the relative performance of the banker's dozen. Now, let's compare the two measurements of risk. First, let's draw the risk-free yield curve. Government bonds with longer maturities have higher yields, or greater amounts of risk. Next, we draw the banker's dozen portfolio size curve. Portfolios with larger sizes tend to underperform those with smaller ones, i.e., lower preference for risk. Together, consider the y-axis to represent the preference for idiosyncratic risk, and the x-axis to represent the quantity of idiosyncratic risk. Overall, the banker's curve is a mirror image of the risk-free curve, and together they form a rough equilibrium of preference for idiosyncratic risk. For example, let's start at the point where the two curves intersect and identify this as quantity 1. Now, assume that the risk-free yield curve shifts upwards. The new point of intersection indicates a lower quantity of risk and a higher preference. But let's assume that the quantity of risk is unchanged. This would drive pressure for the banker's curve to move upwards. Reaching a point where quantity is restored to equilibrium, but the price for idiosyncratic risk is now higher. So, in summary, the banker's dozen is a hedge portfolio that measures the preference for idiosyncratic risk. It may be considered in the context of the risk-free rate. However, the banker's measurement is self-contained in the stock market and not subject to bond market influences. For the latest commentary and daily measurements of idiosyncratic risk, please visit bankersdozen.com. Thanks for watching.